So like I said, we'll be swapping over to Google Meets very likely mid-April, maybe another week, possibly two. And I have thought about just running everything straight onto YouTube and doing it that way. No more Zoom link each day, no more Google Meets link, nothing like that. So that might be another route. That way there won't be any shenanigans either. It's a nice solution to the problem. All right, should be able to see my screen at this point. No, nothing like that. Um, there's just some issues with Zoom. Like yesterday when the stream was hijacked by somebody screwing around with the Zoom settings. And when I looked for solutions to make it where that can't happen, I didn't find the settings that I like. Plus, my renewal on Zoom is coming up, and they don't want to offer me the same deal that I had for the last 2 years, and my price basically just doubled. Why would I double the price on it when I've got other services that I can use? All right, it looks like I've got all the settings adjusted as good as I can. So, good morning, everybody. We're almost to the end of the week. We already have the AM edition on the founders notes, which is nice. I love it when they get out of bed and get things done in the morning. We are green around the world, not overly much. One thing that I heard frequently this morning is how the market took Powell as saying that they are still planning to put in at least one cut this year. Um, the market took that for, oh, June cuts, at least with a 50-50. That's not what he said. And I think the market's going to get a little butthurt when it doesn't pan out. But for the moment, um, that's what the market took out of yesterday's readings. And so one thing that I would caution you for is to watch today. We've got a lot of Fed speakers again today. And one of the things they might try doing is adjusting or walking back what Powell said. Because the way all the data looks, we don't need a cut. And there's some, you know, sticklers who do not want to cut, at least not yet. So we want to listen today through everybody that's talking to see if they try to walk back or rephrase what Powell said yesterday to get the market to back off on this a little bit. This is the July uh, meeting with a 25 basis point rate cut set at 50%. If we look at June, it's set at 55%, and that's down. They unwound from 60, call it 62 to 56. We'll just round up a little bit here. So they unwound that in 24 hours. But in the last week, we're right back where we started, right? We really haven't gone anywhere in a week. put it out to July again. Look at the 50 to 55. It was unwound from a 52.5% chance down to a 50-50 chance. And within the last week, that's up basically a 1.5 or so. But really, nothing has changed yet. Not for those two dates. They are starting to price in September with a cut. We can see, and it's only a minor change, but this is the one that's moving up. Those other two were moving down. So looking at this, it seems like they're just pushing that rate cut out into September. We want to see this continue today. Keep your eye on the September contracts, this 500-525. Keep your eye on that. Let's see if it continues to rise up. And at the same time, we want to see these continue to unwind, drop lower, not too fast, right? We don't want to see everything get out of control. Let's get it down into like 48, maybe 47.5, something like that. That's the July one. And for June, let's just back it off down closer to 50 at this point. We just want to see them easing back a little bit. Also on those two, the June and the July, we want to see this 525-550. We want to see that one begin to rise up. Those need to be dominant, just like it is here on the this is a big old stick, just like it is here on the May 1st, right? This is the upcoming FOMC meeting, and it's also QRA. So really got to keep that in mind, right? QRA on this FOMC is going to be a really big deal, especially if you've seen what's going on in the 10-year and treasuries, and Yellen out already chipping her teeth yesterday. She's also headed over to, well, she's got a lot of places that she's stopping at. She's on the move. Let's just say that. I think she's going to Beijing. Her itinerary was just too much to try to remember. But Yellen is on the move. She stopped in Alaska. They were talking to her in the overnight hours. And so she's very likely going to start dropping hints on what's going for QRA. It's something to continue to focus on as well. So a little bit of a mixed bag. Japan is down nearly 0.75%. They're still talking about intervention. The thing is, when they quit talking about it, that's when I would get nervous, because usually they deny. That's like their standard operating procedure. Just deny, deny, deny. Deny that they're going to do it. And then after they do it, deny that they did do it until they get caught red-handed, and they have to, they always have to show their hand and show where the money's at. And so that when you balance the books, you can always see when they did intervene, but they deny always to the last minute. And right now they're not denying. They're straight out saying, yeah, we might need to intervene. Okay. Russell is up the least, just really dragging its feet. The Dow behind that at 0.25%. The S&P doing a little bit better, but still not amazing. Europe, and then the US at 0.5%, with Hong Kong leading the way, better than 0.5%. So with Hong Kong up, we want to look at the KWEB constituents, those China ADRs. KWEB is an ETF, right? KWEB. Open that ETF up, see the names that are inside it. Really just kind of focus on the highest weighted names in that index. I tend to be a little more forgiving and just focus on China names in general, but really focusing on KWEB would be probably your better bet. Baba, Baidu, JD, PDD, EDU, Neo, XPEV, those kind of names. We are going to get initial jobless claims. That's no joke right there, all on its own, has the capacity to shake things up. And then it's Fed speakers. And as you can see, it's nonstop all day Fed speakers. We also, I believe, have additional auctions today. It only shows one at 11:30, but generally speaking, if there's one at 11:30, we also have one at 11. So just watch the clock. Remember, there's a lot of things that don't end up on an economic list on a day-to-day basis. So many things that happen that we don't even see showing up in here. They're considered, too routine, monotonous, no headline, no excitement, and they just don't cover it. So this is not as a full list of every economic event, including the auctions. So generally, if I see one, I go ahead and assume that there are other ones, and always just watch the clock. It's a simple solution. We can't know every single economic data point that's going to come out on a day-to-day basis. We can't, especially when we think about all the different nations in the world who all have their own economic events. There's just too many. So we try to highlight the biggest, the ones that have a history of being the most impactful. And then behind that, we just keep our eye on the clock, because governments being lazy and being governments, they're going to be routine and use half hours and full hours for their economic data releases. Pretty simple. We're back above the 10-day moving average. And for the moment, anyways, maintaining back above VWAP. It's been relatively calm today. My VWAP resets at midnight. After the reset, we had a reasonable distance in one direction, and then same on the other, like reciprocation, right? Like a reciprocating saw or a jigsaw. So far, we're maintaining that equilibrium, that balance. If you're looking for this to really break and go, you're going to want to see that change. Just proceed with a little bit of caution, because there's the idea of the megaphone pattern, where we begin to unwind a little bit at a time until finally something breaks and it really kicks off. But as long as we're maintaining around the mean or around VWAP, then that's what you're going to want to expect, right? You need to see an absolute change in market dynamics to believe that we have anything else at this point. We did get into liquidity up here. If you're running something like Bookmap or Jigsaw, you will be able to identify if that's gone at this point or if there is still more up there. Looking at how far we are from the ADRs, we're closer to the upper ADR than we are to the lower ADR. Like a magnet, it's much more likely that we will go to the one that we're closer to. But that does suggest that we maintain our inside day breakout. This is yesterday's range. Keeping track of yesterday's range at this point should just be second nature for you. When I see traders in chat that are kind of newer and they say things like, oh, I got really tore up today. It was sideways, choppy, nasty. I should have just sat out. It was so bad. And when I ask them, well, why didn't you? Well, I didn't know it was going to be one of those days. Okay, fair point. We never know what we're going to get. But if you're inside of yesterday's range, it's called an inside day, you should just go ahead and plan on it being choppy, nasty, difficult. And if you want to tighten that up a little bit, if we get into the RTH, the regular trading hours, and we're still sitting inside of our own Globex range, then your expectations have to be that it's going to be choppy, nasty, violent, difficult. So we've got our Globex range, and you can see that we're still inside it. We've got yesterday's range, which we happen to be outside of at the moment. Yesterday's highest point is also where VWAP is at the moment. So we would be looking at a VWAP break and breaking back inside of yesterday's range, which would bring us right down to the 10-day moving average, the 3-week moving average right underneath that is also where the volatility trigger is. And then we've got the daily pivot. At this point, we have not hit that daily pivot. So that's an MDP. We're underneath the weekly pivot, which puts us in a bearish posture anyways. The thing about being in a bearish posture is we would look for shorts because we're underneath that weekly pivot. When the market's headed down, that makes perfect sense. Look for shorts and we're headed down. Great. It's a good combo. But once we start working our way back up, looking for shorts doesn't really make sense, which is why there's not as many opportunities. And it's why you would want to sit out. So it's just a generic phrase. We hear that same kind of phrase with things like the 200 period moving average, even the 50 period moving average, where they'll say, well, you're under the 50, you should be looking for shorts, or you're above the 50, you should be looking for longs. Okay, I mean, that only works until it starts to roll over, right? So with this, if we're going to have longs, we got to get back above that weekly pivot point. Then there's the previous week's close, the previous week's high, the full ADR, and a call wall way up here at 53.52. Put wall at 5,200, zero gamma at 52.31, which happens to also be a cog line, which is also the lowest point of the current week. Not perfectly, it's a few points off, but this is the lowest point on the week. So we would be looking at, some new lows on the week. Not seeing that kind of drama yet, unless one of these Fed speakers screws up and puts their foot in their mouth. And it can happen. I mean, it's just like watching a car race and then getting a wreck. Nobody goes in there planning to wreck. None of those Fed speakers go in there planning to be misquoted by a journalist or misunderstood by the algos, and it can totally happen. So barring some kind of mishap, we shouldn't get so volatile that we come down into 52.30 area. Not today. Having said all of that, though, this is a relatively tight range that we've been holding in since around 7 o'clock last night, between 52.75 and 52.85. It's a 10-point range. It's really tight, and it held even through the kill zone between 2 and 4 a.m. It didn't manage to break out of it even during that phase. Volumes within the mean, within the norm of what we're used to, but it's a little light, and it's kind of been a little light all week. 71. Okay, maybe Tuesday wasn't too light, but Monday in the 40s, Wednesday 70, today 62. That's a little bit of a signal that as we get closer to Friday, the big job data is what the market continues to focus on, and it's likely, other than the Fed speakers, if we just set them aside for a minute, there's nothing else other than initial jobless claims. We're going to do that. And then there's nothing else until non-farm payrolls. If we set the Fed speakers aside for a minute, because they're just such a big unknown. Without them, I would adamantly be saying this is a hurry up and wait mode where we would want to sell into strength, buy into weakness, and expect this thing to chop sideways until tomorrow when we get non-farm payrolls. That would be easy, and I would pound the table and say that. But because of the Fed speakers, we can't. Because there's absolutely no way to tell what those guys are going to say and what their effect is going to be on the market. So base case, sideways, waiting on non-farm payrolls, with an asterisk that says, watch out for the Fed speakers because they can break the whole thing. And that would be nearly 2 weeks in a row of that sideways, just hold it, right? Now that we're on a 10-day, 30-minute, we have the week after FOMC. right? We can see FOMC, the big pop. Let's get into Friday, Sunday, Monday. Okay, there's last week, Monday through Thursday. Just a whole lot of nothing, right? And then into this week, we had a little bit of a breakout to the upside Monday, and we broke out of it a little bit to the downside Tuesday. But where are we now? Right back where we were last Monday, not this week's Monday, but the Monday before that. That's on March 25th. All the way back there. We're right where we were. So hurry up and wait makes sense. We don't have anything on the profile for a classic shape, like a D, E, nothing like that. We are going to lose this data back here today, but we made new data over here. So the profile is not going to change its shape in the rest of this week. At this point, the only thing that would change the shape even more is if we undercut that low. So if we get down below 52.32 cog line, then we could have a new shape in the profile, and that's not expected. That's not our base case argument at this point. This is a bit of a rising wedge. Rising wedges tend to break to the downside, but it's skewed, right? It's not in a clean shape. So yeah, kind of take it with a grain of salt, you know. There is a half back consideration from Monday's high into Tuesday's low. You can see where the half back is there. We're on it. Imagine that, right? Look at that. Now we can overshoot that level and get into the cog line 52.91 or 52.92, something like that. It's a cog line up there. It's also right where the point of control is for this 10-day. We could certainly overshoot, get up into that zone, and still reject and fall back down. That would be like a blow off top before the rising wedge breakdown, which is not unusual when it comes to rising wedges. So really, you would have to use something like 5,300 if you want to go long for a swing trade. You'd have to get above that. Grimes talks about a pre-consolidation breakout, which is kind of like this zone here, where it came down, it got into support level, and it consolidated really nice before actually breaking down. Same thing could be said for an upside move. So if we get up into this 92 and we kind of hold the line there in a pre-consolidation breakout, then go above 53, we could run for that 53.11 cog. That would get us right back up into this volume structure. But right now we still have all of this. So expecting some resistance right above that 50% line. Liquidity resides on the other side of the pivot, right? That's where liquidity is at. So the fact that we got to this line is great, but we need to get through it. All right, so this VPOC is done. It got hit yesterday. We're not going to have a VPOC for today because we've already cut through this zone multiple times. Now, having said that, we can have just a point of control. It's not a VPOC anymore. It's just a point of control. The reason I want to mention this is if you go and study volume profile, watch some videos, read a book, they'll tell you about the three pieces of the profile: the value area high, value area low, and the point of control. And one of the things that most of the books and webinars will tell you is that you can carry forward these levels into today's price action. Now, I've already got enough pivots. I don't need another one. But carrying forward the point of control is a common practice. And at the very least, it can provide insight for you, especially if we have price come back down into that range or into that zone. Just making sure I had my line centered on there. So we're above it now. We're not into it. If we were to cut and make moves for the downside, I think you'd want to know where that point of control is from yesterday. Just keep in mind, it's not, quote, support, resistance. Just be aware of it for what it is. That's the spot where there was the greatest amount of trading yesterday. The greatest amount of volume yesterday happened right there. That's not my guess. I'm not assuming. I'm not giving you some hypothetical, statistical, nothing. It's just fact. That's where the most trading happened yesterday. And so when we come down into that level, imagine how many people who traded yesterday, long or short, who now sees price right back where they started. What do you think they're going to do? What would you do? So we can expect a lot of trading activity at that spot just because it was also heavily traded at that spot yesterday, and we're back there again. When you look at it from that point of view, you don't get disappointed by it. Oh, I thought it was support and we didn't bounce. Oh, I thought it was resistance and we broke right through it, because it's not support. It's not resistance. It is potential support, but we would only know that looking back and saying it was supported. It's potential resistance, but we would only know that when we look back and say, oh, wow, look, it really resisted price when we ran into it. In psychology, they call that unrealistic expectations. The number one thing that upsets people in the world. Imagine that. My psychology degree paying off. So Tuesday, we hit the edge of the expected move, the weekly expected move, and we have held above it. But I thought this is a good time to restate the same statement that I made the other day. When we hit the edge on a Monday or a Tuesday, either we hit the upside, we can look for a downward move, or we hit the downside and we can look for an upside move. We are back above the red line, sure, but we're not sitting up here. We didn't get a move that would warrant buying a call. We could sell some puts, right? Like a put credit spread or something. And if we had, so far, that would be profitable. But we didn't get a move out of this. And that's the reason I don't really focus on buying a call when we hit the edge, or buying puts if we hit the upper edge, because it's not promising you a move to the other side. It's just saying that we should get back in the box, and that statistically we do get back in the box. Now, there are numbers on how often we get to the edge early in the week, like a Monday or a Tuesday, and we get to the other side by the end of the week. There are some good numbers for that. They're not in the 85, 90 percentile, but they're in the high 60s, 70s. So, you can try to do something like buying a call on the other side. It would be a very far out of the money call. It'd be really cheap, like a lottery ticket. And that's just a lottery ticket with some statistics behind it. It's really, really cheap. And that means if you're wrong and it doesn't work, you're not significantly damaged or hurt, right? You buy a scratch lotto for $2 and when it doesn't work, so what, right? You're fine, no worries. So if you do that, it's worth a shot. At least you have a reason, and a reasonable reason, to try it. You just wouldn't want to get some kind of at the money call that would cost you a couple grand and then just watch it sit there and decay and really cause you some damage. So far, we're holding above this 20 period moving average really well. We came down into it, rebalanced, got back above it. I like it so far. It's looking really good. We had the same kind of behavior back here where we got down into it 2 days, rebalanced, and got back above it. Now, we didn't greatly expand, right? We got above our previous level, just by a little bit. And we stalled out again. And then we popped up a little bit more and we stalled out again. It's been a lot of this stalling and popping and stalling and popping. It's just not really getting anywhere because there's so much data coming in right now that everybody's looking for the Fed to finally give them what the Fed had promised. So when it comes to the door, the 3 days is done. Day 1 is the white one, and then day 2 and day 3. So we have our 3-day door. Day 1 open range is door. This is the 3-day open range. And this is how you would mark it. What was the highest point within those 3 days? What was the lowest point within those 3 days? This is now what we have. We're in the middle, and that would be no different than if we had just marked out a single 1 day, the actual door candle, day 1 open range, highest point, lowest point, and we're just sitting inside it. Until we get out of it, we're just sitting inside of it. An open range, whether it's on a 5-minute, a 1 hour, 1 day, 3-day, an open range is just a pivot point like any other pivot point, and you would want to use it just like you would use any other pivot point. Some traders are aggressive. Some traders are a little more passive, they want more confirmation. It's not right or wrong or good or bad, but you pay for confirmation. So the longer you wait to get confirmed on a trade, the worse your stop usually is and the greater risk you have to take. But waiting for confirmation means that you lose less often. Some people are really hung up on not losing for some reason. I'm more hung up on making money and making sure my losses are small and my wins are bigger. Winning is not the goal. Making money is. So trade it how you normally trade any other pivot. We now have a high and a low that gives you 100% the level that you have to get out of, almost like a Captain Obvious. If you want to break down, you got to get outside the box. If you want to break out, you got to get outside the box. If you want to get aggressive, go long before we're out of the box. Go short before we're out of the box. That box doesn't give you any directional bias. It's not telling you to go long. It's not telling you to go short. It's just giving you the boundaries, and we now need to get out of it. One of the greatest things that you can do to better understand any strategy is to go back in the past and apply that strategy. We can see the previous candle right here. We could mark out that 1 day's candle. We could mark out the 3-day range and then see how price responded. How did it act around that range? How did it act when it got out of that range? That's just one. Go back and do 50, 100, 500. Put it on different things. Put it on different markets. This is just the ES. What about the NASDAQ? Does it behave the same way? What about the Russell? What if you're an equity trader? SPY move the same way? Apple, Microsoft? How does it get affected when there's earnings? Those things are best answered by going into the past, applying the concept, looking at what the actual results were, and studying it. Because the problem is, you'll never ask all the right questions for me to be able to give you all the answers. And even if you did, you wouldn't trust me. I don't blame you. I wouldn't trust me. You want to put $50,000 on the line on my word, wink and a nod? Probably not, right? But if you went and did the work, you spent days, weeks, months studying this concept and reviewing it, back testing it, and looking at all the examples and developing an understanding of it, you would be much more willing to put your money on the line because you would inherently understand it to your core because you did all the work. That's not just this strategy, right? That's any strategy. It always works better when you make it your own. Every successful trader that I know has made their own. And, you know, you can't reinvent the wheel. Obviously, we are all trading the same strategy at some point. But the little things that you do to make it yours is what makes you successful. So you got the concept of the open range. What do they say? Grab it and run. Grab it and run. It's worth it. I like it. It's a nice strategy for equities. VIX gave a lot of that move back, but it's still up over the last 5 days, 9%. Even giving back nearly 1% already, it's still up 9.25. Gold is still up 8.5%, even though it's down a little bit this morning. Miners are still up 7%, even though they're down about 0.25% this morning. I'm mentioning that because the things that are down right now are likely just a little bit of a mean reversion, really. It doesn't seem like they're, dragging the market down. They're just taking a breather. These are some really big moves. 7.75, 9, almost 10, 8.5. Those are some big moves. So it makes sense that we're seeing a little bit of pause on the things that are down this morning. For the things that are up, some of these were down considerably. Bitcoin, for an example, is up 1% this morning. It is still down 7.5%. Another Bitcoin product is still down 4%, but it's up this morning 1%. The FANG up, FNGU, is up this morning. I tend to use that in a group. If you develop a ratio chart with FANG up versus FANG down, to me, it seems to work a little bit better, but individually by itself, it's up. Semiconductors are up. And on the week, they're up. So they finally crossed over, for the 5-day change. The China ADRs also up. So nice continuation in those. It's not a bad morning, but we're not seeing everything that we need, right? I'd like to see some more financials in there, which, remember, on the 12th, we're kicking off a new earnings season. We're going to get the banks reporting. But this morning we got China ADRs, we got the Mag 7, and we got semiconductors with Bitcoin. We have all the ingredients we need for one of those amazing ripper run days where we just go, go, go. And after we've already gone as far as everybody could think we could go, we keep going even more. We have one of those days setting up right now. The only thing that I would want to see more of is this financials right there, either through the XLF or KRE. I'm not picky. I'll take either one. It's a little light. I want to see some more of that, but we don't have to have it. I'm just being picky at this point. We've got everything we need. Semiconductors, technology, some extra through the Bitcoin, and then we got China ADRs. This is perfect. Now, one of the things that you can do today is keep your eye on the advancing versus the declining issues. Thinkorswim's got an advanced version of this. Just to understand the menu system up here, we've got one menu at the top, so that's Market Watch. The next menu here, we've got Visualize, and then what do we want to visualize? We want the Index Watch. So Market Watch, Visualize, Index Watch. Now we can choose what watch list we want, and you can put anything in there. You could put your own homemade watch list in there if you want, but they have pre-made lists for you, like the NASDAQ 100, the S&P 100, things like that. This is an advance versus decline, just like a typical AD. The difference, though, is that it also has volume in it and it has money flow, like notional value. So this is a more advanced version of advanced decline. Keep your eye on this. We want to see it at least in the 80s. If you're a little more generous than me, then maybe in the 70s. You get into the 90s, and that's fantastic, right? Don't get me wrong. You will, in history, see things like 100 names all moving to the upside all at once, which is awesome. You just don't get that very often. But in the 80s would be great. Make sure that the capital matches it. Sometimes we'll get a divergence and we'll have, say, issues, which are companies. We'll have more issues going up than down, but we'll have more capital going out than in. That's some divergence within the money flow. So just keep your eye on the money flow a little bit. Make sure that it's following along with the issues. These are detachable and you can stack them. So if you wanted to watch all of the indexes all at once, you can do that. They can be narrowed down into a tight little range, which is nice. and you can pin them so they don't fall behind. Unfortunately, you have to do this every single day, because if you shut off your Thinkorswim with this set like this, when you come back, it will have the heat map. And then you'll have to go in and change it back to the index, and choose the index you want. It's kind of a bum deal, but whatever, right? It's not that big. It's not that big of a deal. You just have to do it every single day. So set it on the indexes that you want. You can stack them. Keep your eye on the advanced decline, which is breadth. We want to see a really positive breadth today if this is going to be one of those rip your face off rally days. One of those days where we just keep going and going and going. And it seems like we've had enough and there's no way we can go farther, and then we go farther again. We don't have a market maker move this morning, but we do have the weekly pivot, the ADR half, the round number 5,300. It's a big deal. 5,311 cog line, some voodoo lines, previous week's close, previous week's high, and the full ADR. A lot of resistance overhead, a lot of pivot points and things like that as well. Below us, we've got a lot of support. 10-day, 3-week daily pivot, previous week's low, even the 20-day moving average with a volatility trigger too. So it seems like we go to the upside, we got a lot of resistance. We go to the downside, we got a lot of resistance. We just got to get it out of this zone. And it's a hurry up and wait day. So we have all of these positive things telling us that we have the capacity to break out and run. And yet we've got non-farm payrolls tomorrow, which says we should sit tight, hold the range, and wait on data. It's a little bit of a conundrum at this point. This says we can make it, we can go. So one thing to watch for, remember Monday, how we were up in the pre-market, we got into the open, we popped just a little bit higher, and then we rolled over and face planted like a rug pull. Watch for that today. Because while all of this looks really good and says that we could have one of those days, we've got a really big data print tomorrow, and we got a lot of Fed speakers today that can muddy the water. So just be ready for the trap, right? That's what I got for you guys. Be careful, be